I'm David Marcus, a reporter at The Deal, with John Rogers, a partner at Pepper Hamilton in New York. John, thanks for joining us today.
Oh, you're quite welcome. Good morning, David.
You advise private equity shops who focus on the lower middle market. Let's talk about some of the challenges those shops have in sourcing, winning, and executing deals. First of all, on sourcing, what are the challenges and opportunities that PE shops with that focus have?
Well, when you look at the overall private equity world, I think the lower middle market is still viewed as the most disintermediated segment in the market. There are still opportunities that are very good opportunities that are underbanked, and sometimes you have companies that the story are not well positioned for the market, or the story is not correctly communicated to the market, and then that provides some opportunities for private equity shops to come in and buy companies at lower multiples because they're not widely auctioned. I think when you look at the lower middle market versus the regular middle market, I think we're seeing deals getting done between 5 and 6.5 times EBITDA. In the lower middle market, the regular middle market, it's anywhere from 10.5 up to even 12, 13. So there's a huge difference between the entry point in terms of valuation between lower middle market companies and middle market companies. Part of that is driven by the inefficiencies, and like in any market, inefficiencies are where buyers derive value.
And how should PE shops go about winning these deals once they see the opportunity?
Well, I think when you look at lower middle market deals, the vast majority of them involve some level of rollover equity that helps finance the deal. And I think a lot of family-owned businesses, which is sort of the prime target for lower middle market deals, most of the founders realize that the valuations don't match their expectations of what they think they need to retire on. And they view that piece of rollover equity, that equity that's going to be handled now by a private equity firm, as really being their highest yielding asset. Placing your business that you've built up, as well as the highest yielding part of your investment portfolio with a custodian, involves a tremendous amount of trust. So trust is a very important factor in winning bids in lower middle market deals, developing trust with the founder, developing some comfort level, and that is all about personality. There's no underestimating interpersonal dynamics in lower middle market deals, as well as the power of personality.
And finally, execution. These tend to be very leanly staffed deals, correct?
That's right. A lot of the lower middle market private equity clients that I work with are independent sponsors. They could be one person, they can be 3 people. They don't have a large infrastructure around them, so their approach to getting deals done is to be very streamlined, very efficient. I think it's important to get a good team of advisors around you, a good lawyer, a good accountant, that can help supplement the capabilities that you wouldn't, or you would ordinarily have if you were a much larger shop. So you need outside advisors that can take a little bit more of a business role and going to ramp up a little bit faster on financials, how a company makes and loses money. So there's less time translating if you're a business guy in the lower middle market.
John, thanks for joining us today.
You're welcome.
For The Deal, I'm David Marcus.